I'd like to introduce our speakers for this evening. We have three of them, Francois Halou, John Catan, and Fraser Lang. First, Francois has held senior positions at several Canadian financial institutions over the past 24 years. He's worked closely with corporate clients to establish risk management and investment solutions involving interest rate, equity, commodity, and foreign exchange. Over the years, Francois has been involved in presenting financial seminars and educational workshops. He holds an engineering degree as well as an MBA from McGill University, and as well as a chartered financial analyst designation, a CFA. John has also held senior positions at many Canadian financial institutions over the past 25 years. He also works closely to also establish risk management and investment solutions involving interest rates, equity, commodity, as well as foreign exchange. He holds a BA from the University of Toronto, an MBA from the University of Toronto, and also holds a designation of a CFA. Fraser is a key member of the Gordon B. Lang and Associates. He works with corporate partners, direct clients, and their advisors, developing personal and corporate tax strategies that augment client retirement assets and assisting in overall tax and estate planning. He graduated with a Bachelor of Arts in Psychology from the University of Alberta. Gentlemen, you may continue.
Thank you, Dr. Spears, and thank you very much for listening tonight. We begin our webinar tonight with an overview of the retirement trends in Canada. A lot of people associate retirement planning with something they should start thinking about when they approach retirement. In fact, retirement planning should start at 18 with your first TFSA contribution. If you don't plan ahead, you will fall short of the way a lot of Canadians do, as we will see in the next slides. We then expand into professional corporations. We will give you an overview of tax planning using a professional corporation. Please note that although we work extensively with our clients and their tax advisors on various tax solutions, we do not provide tax advice. We will give you our understanding on the tax issues. We have a lot of expertise in that area, but ultimately it is important that you seek your own independent tax advice. We brought with us a team of experts. Dr. Spears introduced them earlier. In addition to Fraser Lang and my partner John Catan, we also brought with us Jim Kraft, a tax and estate planning specialist, and Tim Simpson, an insurance structuring expert. Both Jim and Tim are with BMO and will assist us in answering your questions. We will take questions in the end. If your questions are very specific to your situations, we can take this offline after the webinar. So the very first section of tonight's webinar will be on retirement planning in Canada, and we wanted to give you an overview a little bit of the facts and statistics of the retirement planning. In terms of, we will start with the baby boom generation and whether retirements and how does it stack up with the reality of what people have been talking about for the past few decades. A fairly large number of the baby boom generations are now retiring or starting to retire. In fact, those born between 1946 and 1965, the youngest one of them are turning 50 this year. The Canadian boomers struggle with retirement planning. BMO Wealth Institute did a fairly extensive analysis on the baby boom generation and the results of their retirement. And what it found is that only 54% feel that they will be financially secure in old age. Only 16% feel very confident they will be able to retire comfortably. And the current average savings is about 35% of the $658,000 that the average boomers feel they need for retirement. In other words, if each boomer feels that they need $658,000 to retire, what they have saved up right now is about 35% of that amount. So for a retired couple, we're talking about $1.35 million. The average senior couple, according to Statistics Canada in 2009, spent about $54,000, $54,100. Interestingly, if you multiply $54,100 by 25, assuming a retired couple lives together as a retired couple for 25 years, you get bang on about the $1.352 million that our study found. The effects of lack of retirement planning are fairly significant. The boomers expect to push their ideal retirement age by 4 years, from 59 to 63. 71% of them expect to work part-time during retirement, and that may very well be a choice as well. But what is not a choice would be 44% will sell collectibles, antiques, and possessions they no longer use, and about a third of them will expect to sell their home to fund their retirement lifestyle. Now, what happens with the next two generations, the generation X and Y? And of course, neither one of these two generations, have had, they're too young to retire. The Wealth Institute did a significant study with respect to what their retirement dreams are and what they expect from the future. And very, very interestingly, both of them, Generation X and Y, the result came out very similar for both. And their three primary financial objectives that they listed were buying a home, saving for the children's education, and preparing for retirement. And their ideal retirement age in both cases came very close to 62 years. Now, if we look at what are the challenges to the three stated priorities? If you look at buying a home, effectively, you see a much bleaker picture with respect to home affordability. Within the past 17 years, their income grew by about 50% in Canada, but the average housing price more than doubled. And as far as saving for the children's education, there is increasingly what they call the pensioner effect, with more than 50% of new mothers being 30 and over in 2010, compared to 20% in 1974. Obviously for career reasons and also because of house affordability as well, this is creating its own issues with respect to retirement. As people move into their mid to late 50s, that is the time where the children start going to university and start incurring the cost of university, including those who have saved for RESPs, that in most cases doesn't really cover the cost of university if the kids go out of town. So you have that effect of going into retirement at the time that the kids are going to university and incurring the costs. The third stated priority being preparing for retirement. Now, the good news is, obviously, there's been an increase in life expectancy from 72 years old and 79 for male and female in 1982 to 80 and 84 for male and female, respectively, in 2012. So we're talking about male living 8 years longer and women living 5 years longer. But that's good, but that's also creating, longevity is also creating its own retirement challenges on both fronts. Obviously you have to pay for your own retirement as you live longer. And if we look at $54,100, the cost of a retirement couple, the couple retired, spending every year. If you look at here and you look at the common denominator being 5 years, men and women living longer together. So we're talking about $250,000 in additional retirement costs of this longevity. In addition to that, there is what has been coined as a sandwich generation, where you have the pensioner effect that we mentioned earlier. You're going into retirement, your kids are going to university, in most cases coming back from university and looking for jobs, which may, in many cases, take a long time. And if you add to that the fact that the parents now are living, your parents are living longer, and the in-laws are living longer, you and yourself basically caring for two sets of generations, the children and your own parents. Over 93% of those who were surveyed rated financial planning as an important tool for their families' long-term financial security. But interestingly, less than 50% of baby boomers, about 44%, and 35% of Generation X and Y actually have a financial plan. And of those who have a financial plan, only a third of them actually have updated it in the past year. So you can see the challenges between what is expected out of retirement and the way people are actually planning for retirement. And a small minority of those who were surveyed stated to be very confident to retire comfortably. We mentioned 16% of baby boomers earlier, but the Generation X isn't much better, 17% very confident of retiring early, and 26% of Generation Y. Now, if we go to the next section, I'm going to go through a quick overview of the registered plans that apply to retirement planning. The registered plans are called registered because they're registered as such with the Canadian revenue agencies as being tax efficient plan and not being taxable while the money is growing into these plans. So the contribution of some of them are tax deductible, primarily the RSP and the pension plans. Now, for you optometrists who are, have your own personal corporation, the pension plan that would apply would be the individual pension plan, and that Fraser will go through in more details a little later in this webinar. Other contributions are not tax deductible. The RESP, although RESP is not a retirement planning, it's more of a registered education plan. But it is not tax deductible. But what it does is that it involves a government contribution when you contribute into it. And finally, there is a TFSA, which is neither tax deductible nor are there any contributions to that, but they are extremely flexible in a way that the money that goes into the TFSA grows tax-free. You can withdraw it anytime you want. You can reinvest into your TFSA, and when you draw it, all the money that you made within the TFSA basically is tax-free. So it's extremely flexible, and you have no strings attached with Revenue Canada with respect to the TFSA. Now, on a quick overview of the registered saving plans, we have the RSP, which is, most of you guys have heard of. The maximum contribution is about $25,000 this year, a little bit more next year. As I mentioned, it basically is tax deductible. You get a refund from your income tax on that, and it terminates on the year the beneficiary turns 71. At that time, if you draw, you have to terminate your RSP. So if you draw your entire money, you're taxable as income, irrespective of whether it was capital gain or income. Whatever has grown since your investments is taxed as income, unless you roll it into what we call the RRIF or the LIF, in which case it is the amount that's in the RIF or the LIF is not taxable, but they are subject to a minimum contribution, a minimum withdrawal every year that is taxable as income. You have the TFSA, which is in the latest budget has been increased from $5,500 to $10,000 a year, and I will go a little bit through some detail on the TFSA in a couple of slides from now. And you have the LIRA, which is for a lot of you who had a pension plan, who have left your employment with a pension plan, or who had an individual pension plan and terminated that pension plan earlier. It is locked into what we call a LIRA that actually stays on until you roll it into a RIF at the age of 71. The next one is I mentioned it here in passing, but it is a plan that is not very known by a lot of people, and it is a registered disability plan, and it is applicable to people who qualify for the disability tax credit. It's actually a very generous plan, so it could be for disabled people or individuals who have children or a child who is disabled. It has contribution that could go on to the age 59. The governments have some very generous contribution in grants and bonds that cease at the age of 49. In these contributions, you have a Canada Disability Savings Grant that can add up to $3,500 a year, up to a lifetime maximum of $70,000, and the Canada Disability Saving Bonds that can add up to an additional $1,000 a year, up to a lifetime maximum of $20,000. And it has a maximum contribution of $200,000, and the RDPSP income at maturity of the disabled individual would not affect any other type of plan, such as a CPP, OAS, or other government pension plans, some of which maybe are subject to clawback depending on your income, but that wouldn't apply in the case of RDPSP. And finally, you have the registered pension plans, the CPP being the most known. If you are self-employed, your contribution will work out to be about $5,000 a year. And if you're an employee, it's about you split that with your employer. Depending on the age on which you start drawing on your CPP, if you start drawing at the age 60, you receive about $8,300 a year. At 65, it's $12,780, and at age 70, it's $18,000. The CPP payments are subject to income. It would be subject to your income at the time that you receive that amount, which would presumably be lower if you've stopped working and you're retired. Then you have the OAS, which is primarily when for a lower income, and it is subject to clawback, and it is completely and totally clawed back if your income exceeds $117,000 a year. You have the GIS, which is primarily for low income OAS recipients, and you have allowances as well. Now, before we move to the next section, I wanted to spend some time on this chart that shows a little bit what the effect of contribution in TFSA. One thing we hear a lot from people is that TFSA's contribution of $5,000 a year, 10 grand. It's a drop in the bucket when it comes to retiring. But if you look at what a $5,000 per year corresponds to, it's about $14 a day. And you look at a contribution that you make, in a disciplined fashion every year for 35 years. Your contribution, let's look at the last line of 35 years. Over 35 years, $5,000 over 35 years works out to be a total contribution of $175,000. Assuming an annual rate of return that compounds tax-free in the TFSA would work out to be $739,000. 7% in an annual rate of return is actually very realistic. If you look at, and we've done a lot of analysis on that, if you look at the way the TSE 60, which is basically the index that represents the Canadian stock markets, the way it has performed over the past 35 years in terms of its price performance and its dividends as well, it solves something in excess of 7%. For example, if you buy a basket of bank stocks that pay a dividend of 2 to 3% per year, all you need to have is banks improving in price by 3 to 4% a year, which is a very conservative scenario, and you get to something in excess of 7%. So it is very realistic. Now, if you look at two people contributing $5,000 a year, yourself and your spouse, you see that the 739, you double that, and you are at the 1.5 million that we discussed earlier, which is basically what is needed to retire. And this is by only using half of your TFSA limit of $5,000. The limit right now, the maximum limit right now is about $10,000. So, if you take a step further, $10,000 a person, two people, and we're talking about $3 million in 35 years with a contribution in terms of what you would receive. And that amount of money is not subject to withholding tax or any type of tax by the government, unlike the RSP, because it was invested with after-tax money on the way in. What you withdraw in the end, if you can grow it to 739, 1.5 million, 3 million, that is the amount of money you walk away with without it being subject to any tax. So I'm going to now pass it on to John Katan, and we are going to speak a little bit more about the professional corporations.
Thank you, Francois. And again, thanks for joining the webinar this evening. My name is John Katan, and what the focus of the presentation at this stage is really around professional corporations. So to start with is, what is a professional corporation? Essentially, it's not a defined term under income tax, but essentially is a estate and planning vehicle that can be used by regulated health professionals to allow them to set up a company in a more tax efficient manner, which we'll discuss later. But essentially, it has to be regulated by the Health Professions Act. It has to be regulated under the Health Professions Procedural Code, and more importantly, it's incorporated under the Business Corporations Act. It is a Canadian-controlled private corporation, which means that it's a separate legal entity from its owners and is required to provide annual financial statements and annual tax filings. And how do you go about and set up a professional corporation? Well, essentially, it's a two-step process. First thing you have to do is set it up under the Business Corporations Act, and then that will provide you an articles of incorporation. Subsequent to that, then you have to go to and get it certified by and through the certification of authorization from the college, and that will define what you can do within the professional corporation under your regulated entity. The rules and regulations pertaining to professional corporations. So there are a number of things that have to be adhered to. One, all PC shares should be owned by optometrists. All PC officers and directors should be shareholders. The PC name should include personal corporation. The PC should not have a numbered name because sometimes you have numbered companies. That's not available in this case. And the only practice is optometry or related or ancillary activities. And a related could be, providing eyeglasses as an example, or ancillary is being able to invest the funds that are generated from the business. What business can a professional corporation carry? Essentially, there are three components of that. One is the practice that's directly related to optometry. The second piece is, as we discussed, is the ancillary parts of that business, again related to optometry. And then the investment of surplus funds. And so as you generate income, and to the extent you don't have a use for the income to live on, you can invest those surplus cash into investment vehicles within the professional corporation. So what are the advantages of a professional corporation? Well, the first thing, that the key reason for using a corporation is what we refer to is a small business deduction. So to the extent that you're using a personal corporation for your optometry business, the first $500,000 of that income is taxed at a very low tax rate, i.e. at 15.5% in Ontario. Whereas if you were to run that business personally, the tax rate would be 49.53%. So hence, as you can see, this is significant tax savings. You can also then the question is, how do you get the money out of the corporation? You can essentially pay yourself a salary. If you do pay yourself a salary, it'll generate a T4 like any source of income, and you pay tax on that income. You could pay yourself a dividend, and there's different types of dividends, which I'll get into a little later. And then you can also establish an individual pension plan within a professional corporation, which Fraser will get into in more detail. But essentially, it's a savings vehicle that's available to you. There are also some advantages of certain expenses. Certain expenses are non-deductible, that if you were to incur those expenses through a personal practice, you'd be paying those from after-tax dollars. Whereas if you paid within a corporation, you're paying it before tax dollars. So it's more cost advantageous. Income splitting. If you and your wife are optometrists, you both can be shareholders, and you can both pay yourselves a salary and hence split the income. And that's to reduce the tax liabilities to avoid going into the higher tax bracket. Capital gains exemption. If you're in the future, if you decide to retire and you want to sell the practice and you're able to sell the shares of the professional corporation, there is a capital gain exemption that's available to each shareholder. So hence, if you and your wife are optometrists and you each have shares of the corporation, the first $813,600 for the current year would not be taxable, and that would apply to each you and your wife. It's not a combined number. The other thing that's also relevant here is if you hold U.S. securities within a professional corporation, it also applies in a regular corporation, you avoid U.S. estate taxes, which can be a very significant liability upon death. And because the reason for that is because the corporation is a survival. It survives on its own. It's not, if the owner were to pass away. So the other thing is, if let's say you have an existing practice personally, how do you transfer an existing practice to a professional corporation? So generally, when you transfer property from one entity to another, it's always subject to income taxes. There is a deemed disposition. However, in the case of optometry, if you sell an optometry practice to a PC, there may be ways to do that on a tax-deferred basis. You have to file a certain tax election form within a certain period of time. It's got to be within a short period of time to achieve that tax deferral. The other thing is, what I'll discuss is how to reorganize a PC. Now, it's possible to reorganize the share ownership of a PC to make it available to other members, assuming they're optometrists. So as your kids become optometrists, you can get them to become shareholders, assuming they're obviously age of a majority, which they would be if they're running an optometry business. If a PC becomes a non-professional corporation, then the way it would work is, let's say you decide to retire from a from optometry, the PC can then become a regular corporation as a result of non-renewal of its certificate, and that corporation now continues to exist. So in other words, upon retirement, you don't have to wind down the professional corporation. It becomes a regular corporation at that point in time. And at which time you can then bring in new shareholders, and it doesn't matter whether they're optometrists or otherwise, i.e. your children. So in both cases, corporate reorganization may offer tax and estate planning advantages in addition to multiple access to the capital gain exemption. Considerations. One is there are ongoing costs associated with a corporation, be it a professional corporation or a regular corporation. As mentioned earlier, you have to incur financial statements each year, and you have to do annual tax filings for the corporation in addition to yourselves. And that's an annual cost. In addition, there's a setup cost because of setting up a corporation and setting up a shareholder agreement among the shareholders. The personal corporation does not avoid limited liability. So for malpractice, you still retain that liability. Losses in a professional corporation can only be offset by gains within a corporation. So if you have investment losses in a PC or a regular corporation, the only way you can use up those losses is if you generate gains within the corporation. And the other thing to note is that professional corporation or any corporation may not necessarily work if you are relying on that income that's being generated through the practice to live on. So in the early stages of your career, it may or may not make sense to have a professional corporation from a tax perspective. But as your practice becomes more successful, and you're able to generate income in excess of your regular use, there is definitely advantages to that, to having a personal corporation. The next section I want to get into is distribution strategies. How do you get money from a professional corporation to you personally? One is you can use an insurance program that essentially would allow you to create a death benefit, and in which case it gets credit to what we refer to as a capital dividend account. And I will discuss that in more detail later. But it allows you to essentially pay out a dividend to yourself tax-free. The other way to get monies out of a corporation is if you have a personal insurance policy, you're able to sell that personal policy to the professional corporation for fair value and get money out that way. The third way, obviously, is to pay yourself a salary as part of on an ongoing basis, and that salary will be taxable to you as regular income. And the third element that we will address is the eligible and ineligible dividends. So there are essentially four ways to get money out of a professional corporation. In terms of the first one, life insurance, it's definitely a very powerful tool for tax and estate planning with or without a professional corporation. Certain life insurance policies provide ways to essentially generate income within a tax-sheltered manner, as income is not taxed within the policy. Furthermore, this growing policy over time creates what we refer to within insurance terms, a cash surrender value. And that cash surrender value within an insurance policy can actually be leveraged. In other words, if you need money, you can borrow against the cash surrender value up to 90%. Types of life insurance policies. There are three really. The first two are permanent policies, and which allow for growth on a tax shelter basis. One is universal life, whereby you manage the investments on yourself. There's the whole life policy, which essentially the insurance company pays annual dividends that they set on an annual basis, and that dividends is paid into the policy and is reinvested to provide more insurance over time, and that dividend is tax-free. And there's term insurance, which typically has a specified future time horizon and could go up to age 100. So what's a capital dividend account? Capital dividend account represents the professional corporation's cumulative non-taxable portion of any capital gains that is generated from investing. So if you, let's say, buy a stock and you bought it at 100 and you sell it for 200, typically 50% of that gain is non-taxable, and that 50% of that gain will be a credit to the CDA account. Other non-taxable amounts is typically insurance proceeds. So the death benefit on an insurance policy, to the extent it exceeds its cost base, average cost base, that differential essentially gets credit to the CDA account. So those CDA account credit balance, if you wish, can then be paid out to you as a dividend tax-free. The important thing here, this is all cumulative at one point in time. So generally, when you have a credit balance in a CDA account of any material amounts, it would be best to pay that out at that point in time, because any future losses would essentially wipe out that CDA credit balance. So let's look at a situation here where an insurance strategy might work. First, and this is happens quite frequently, a successful optometrist over time might accumulate a large sum of money within a PC. Now, what's he going to do with that money? If he takes it out, he's going to pay significant tax on the way out. So what he could do is essentially take a portion of what's in there and buy an insurance policy. And it could be a permanent policy or a term policy. The reason for the permanent policy is because there's additional growth within the policy. And so what happens as a result of that is when the policy itself is owned by the professional corporation, and the beneficiary of that policy is the company. Upon death of the owner or shareholders, if there's multiple, then there is a death benefit that's paid to the corporation, tax-free, and that death benefit in excess of the ACB goes into the CDA account. And through the will mechanism, because every corporation has its own will, that can be then paid out to the shareholders or to the estate of the owners. The other thing is, if you're in the top income bracket of $220,000 in Ontario, which is the highest tax bracket you can have, any distribution to the PC owner outside the CDA is taxed either as an eligible dividend, which is 33.8% today, or an ineligible dividend, which is currently at just over 40%. So as I mentioned, the solution here on the next page is essentially to buy the insurance policy within the company and create that CDA benefit for the company rather than paying the dividends, which is much higher rates than you would otherwise have to pay. So upon the death of the life insured, which could be the PC owner or could be a joint last to die, i.e. his wife, and there's benefits to doing that in terms of reducing the cost of insurance, that death benefit is then paid into the CDA account. Now, one thing to note here, there's changes coming up in terms of these mortality tables that insurance companies are using effective January 2017. What that means is a number of things. One is it's going to increase the cost of insurance because what they have done is they are bringing up to date the fact that people are living longer, as Francois mentioned earlier. So currently they're using tables going back 20 years or so. And so there's a real advantage if you're looking to do insurance or buy insurance of doing something before this specific date. The other thing is within these permanent life policies, this longer mortality tables will actually increase the cost basis of the insurance policy upon death, which means it reduces the amount that you can credit into a CDA account. And you wanted to point that out. The other alternative is to sell. One option that has been done a lot is the sale of personal life insurance that's held in a personal capacity. Let's say you have a term policy or a whole life policy or a universal in your own name. You can effectively sell that, and you have a PC corporation. You can essentially sell your policy to the company and make the company the beneficiary of that policy. That policy you'll receive a cash amount equal to the fair value of that policy. And that would have, if the policy was entered into when you were of a younger age, and you decide to sell it today, there will be an increased value of that policy because it would be more expensive to enter into that same policy today. The key thing to note that any sale of a PC policy to a PC or entering into a policy within a corporation, the PC becomes both the owner and beneficiary of the insurance policy. Another distribution strategy that is the eligible and ineligible dividends. So what is an eligible dividend? Essentially, if, let's say a PC corporation owns common shares of a Canadian listed stock, like a bank stock, the banks typically pay dividends that are defined to be eligible dividends. When the PC corporation receives that dividend by owning the bank shares, it retains its character. And so it can pay out those dividends it receives to the shareholders as an eligible dividend at 33.8%. The other form of eligible dividend essentially is if your practice is earning income in excess of the small business deduction, which currently is $500,000, then the amount in excess of the small business deduction, when paid out, is an eligible dividend. The reason for that is because any amount in excess of $500,000 is taxed at the higher rate within the corporation. The ineligible dividend essentially is any investments that are other than dividends. So if you are investing in rental properties within the PC, or you're investing in bonds, GICs, those are interest income. They get taxed. They're going to get taxed at a higher rate, and essentially, but because they're interest and rental income, they unfortunately are also taxed as an ineligible dividend when you pay out at 40%. However, there's an adjustment process within the company that allows for essentially equates what you would have been taxed externally the same as what you'd be taxed within the company. It's a complicated procedure, but we'll be happy to discuss with you offline. So with that, I'm going to pass on to Fraser to talk about the individual pension plan.
Excellent. Thanks a lot, John. And once again, thank you everyone for hanging in there with us on a hockey night. I realize the Stanley Cup finals are starting tonight. What I'd like to do is just give you a quick overview as to what an IPP is, and we'll go through some of the funding numbers and it'll make a bit more sense. If you have incorporated or if you're looking at incorporating, one of the key advantages that you have of doing so that you wouldn't have otherwise within your practice is the ability to establish a corporately funded pension plan. Now, within Canada, there are two types of pension plans that exist. One is a defined contribution plan, which is similar to an RSP. What happens there is you have funding room, you make your contributions, whatever the investments return at the end of the day is what you have as a pool of money for retirement. The other option that is available, and it's not often available to the individual business owner, is a defined benefit pension plan, which is similar to what the teachers have or some of the public and some of the private larger firms have. So what a defined benefit pension plan is the ability to say, based on the number of years of service, the amount that I've received in T4 income from my corporation, the age I entered and exited the plan, here is what I will have as a specific funding stream or pension stream in retirement. What the IPP in a nutshell is a self-directed version of this type of plan. So unlike a group plan where upon the death of yourself and your surviving spouse, the assets would flow to the other members, in this case, what happens is this is a plan that's set up for yourself, for the owner of the company. If something was to happen to you and your spouse, the assets would either flow to your kids or your estate, depending on what you elect. It would be taxable in their hands at that point, but that is an important consideration. Some of the advantages here that we're looking at is contributions to the plan are tax deductible to the employer. So we are using pre-tax corporate dollars to fund the plan, as opposed to an RSP where you're using post-tax dollars. So what the impact there is if I'm receiving a significant amount of money from my practice, it goes into my corporation, and I paid myself enough salary for lifestyle. If I still have money in the corporation and I want a means of getting it out tax-free, the IPP allows you to get that money out tax-free, and you would pay tax on it down the road when you receive your income in retirement. We are also providing an increased pool of retirement assets if you make full, if the business owner makes full use of the RSP room available, and the assets in an IPP are locked in, and thus they are creditor proofed. So that's an important aspect when you're looking at planning this for your retirement. Do keep in mind that you do need to have an incorporated business that is providing you with employment income in order to be eligible. IPP contribution room would be calculated by as a function of your age and the amount of T4 income you've received from your corporation. So as John had mentioned, there are dividend strategies. When you are using dividends, they are not considered employment income and they would not create room. So the candidate that we're looking here normally when you're looking at a plan is a shareholder of the professional corporation. We do say age 45 to 71. We have set these up for people as young as age 38 to age 40. The reason I say that is age 38 is where an RSP contribution and an IPP contribution cross over. So if you were younger than 38 and you were saying, I'm thinking of looking at an IPP, when we do the calculation, you're actually getting a lower contribution than you would have gotten if you just stuck with the RSPs. So often 45 is the low end people are looking at because they want to have a little bit of a spread between what they could have put into one versus the other. I do see probably age 40 is often the floor there. Age 71 is the maximum age for it. The reason for that is after age 71, you need to start taking your income from the plan. So it's similar to an RSP in that regard. You also want to have a stable business history. There is the requirement on an IPP if you've T4'd yourself from your company to make a contribution annually for that. So unlike an RSP where you can say, oh, I don't feel like contributing this year because I'm remodeling my kitchen, let's say, you are required to make a contribution if you have received that T4 income. As we've mentioned previously, there does need to be the corporate sponsor with T4. And to max out an IPP contribution in 2015, you would need to earn a T4 from your professional corporation of around $141,000. And as I mentioned with the dividends, you want to avoid an all dividend strategy, which is a case where one takes their compensation solely as dividends and there's no employment income. Now I want to show you an example here of a 55-year-old. Now in this case, this is someone who is had 20 years of service within the corporation and they've made maximum income. You'll see at the far right under what we call current service, which is what your annual contribution, that an individual who's 55 years old making $141,000 or more in T4 would have a contribution of $35,100 versus the roughly $25,000 you could put into your RSP. So you're getting $10,000 more as a contribution in year one. The other side to it, which is very interesting for a lot of owners, is this element that we call past service. What past service is to say, had I been in an IPP back to my date of incorporation, this is the money over and above what I could have put into my RSPs for those years, plus a 7.5% assumed rate of return. Because it is a defined benefit plan, there needs to be an interest rate assumption on the plan so we can project your future pension. The government since 1990 has legislated a 7.5% rate of return. So if your plan does not hit a 7.5% rate of return, you would top up the plan using corporate dollars that are deductible. And one flip side to that as well is to qualify for this $188,000 that we're talking about, you'll notice at the bottom it is subject to an RSP transfer of $486,600. What that is what you could have put into your RSP based on your income for the past 20 years plus 7.5%. So if for whatever reason you had less than $486,000 in assets, perhaps you made spousal contributions, or perhaps you own Nortel stock in the past, who knows. As a result of that, if you have no unused room, that $188,000 would be reduced based on what you have available to transfer into the plan. So what are the advantages of the plan? You get greater tax deductible contributions compared to an RSP. The assets are fully creditor proofed. The operating expenses of the IPP are tax deductible. So any fees that your actuarial firm, and you do need an actuary to establish and maintain one of these plans, their fees would be deductible to your corporation as an expense. As well, any investment expenses would either be directly or indirectly deductible to your corporation as an expense. So what I mean by that is if you had a managed fee or a flat fee type expense, they could actually bill your corporation directly for it. And if it was something like a mutual fund where there's something called a management expense ratio, that would be discounted against that 7.5% performance. So the 7.5% is net of fees. As well, the plan surplus belongs to the participants. So unlike a group plan, it's not flowing to other people. It can't flow back to the corporation. Whatever is in the plan stays in the plan. And also investment returns are balanced by contributions. So if we say that there's an assumed 7.5% rate of return and you say, I would like to have a bit more of a conservative portfolio, I don't want a lot of risk there, or perhaps I even want to artificially create a return that's lower than 7.5% in order to get increased funding room, you can do that. So it does pay to have your more conservative investments in your IPP rather than your RSP where there is no ability to top up. And also, it is a great estate planning strategy if you have family members who are shareholders and plan holders. So if you had another, let's say an adult child who is an optometrist who joined the practice and became a shareholder in the professional corporation, you could add them onto your IPP. It's a joint plan. Upon yourself passing away, the assets within the plan would stay there and would flow to them tax-free. And basically, they would have a contribution holiday. So that's a great estate planning opportunity. Now, I wanted to show you an example that's probably closer to what you would run into with your professional corporations, looking at how many years optometrists would be able to incorporate. So more of a standard example of a 50-year-old who's incorporated 6 years ago. In this case, they would have a past service amount. So that's that amount I mentioned to you over and above their RSPs. That the company can contribute of $43,700. As well, their current services here would be $31,900. If we were to take the $43,700 and add the RSP qualifying transfer to it, we would have an amount of $184,320. If we also look at the IPP contributions, the annual contributions from age 50 to age 71, based on current numbers, we're roughly looking at $1.56 million. If we take those numbers and we compound 7.5% per annum over that period of time, we have a growth up to $4.1 million. And if you take your IPP pension directly from the plan at age 71, your company could make a $123,000 contribution to provide for enhanced indexing on the pension, which brings the total assets up to $4.23 million. If you look at the bottom, if we looked at an RSP-only strategy, assuming it also grows at 7.5%, you would only have about $2.76 million over the same period of time. So we are looking at roughly $1.5 million more in the IPP versus that into the RSP. Now, who can the beneficiaries be within a plan? The spouse can be the main beneficiary upon your death. Adult children can be named as contingent beneficiaries. So in the event of you passing away, the assets can flow to your spouse's unlocked RSP tax-free. If they were to pass away, you could either elect your estate as the beneficiary or elect your children in equal shares where they would receive, the amounts would be taxed and they would receive the after-tax portion. So that is an important consideration. And finally, I just want to talk about what happens on retirement or what happens if you sell your practice, the shares of your practice with regards to the IPP. You basically have three options in retirement with the plan. The first one is to take the pension directly from the IPP. The key there is you need to have that corporation continue to exist. Even if it becomes a holding company, you can still have the plan associated with it. There's just no top-ups to the plan. If you sell the corporation or no longer want an IPP, you would wind it up to what we call a locked-in retirement account or LIRA account. It would be invested at that point similarly to an RSP, and then at such time you decide to draw on the money or age 71, you would have the normal options there. And the final option is to purchase an annuity with the assets, which we don't tend to see too often. So that really covers off the IPP section, and I'll send this back to Francois.
Thank you, Fraser. And we will tackle the last section of our presentation of the webinar tonight. and that's in respect to the tax and estate planning strategies for your personal corporation. Now, let's start in the tax and estate planning with respect to what happens to your registered plan upon death. Whether you have or you don't have a personal corporation and you have registered plan, and this is a question that's asked of us all the time. What happens to me if I pass away? What happens to the registered plan that I have, the RSP, RIF, an annuity? So with respect to the RSP, there is an immediate, when it comes to the spouse or the common law partner, it rolls over tax-free. So of course, if the spouse is less than 71, your entire RSP rolls over tax-free to the spousal RSP. And if your spouse is 71 and over, as we mentioned earlier, your RSP has to go into a RIF, which is still a tax savings plan, but you cannot contribute to it anymore, and you have a minimum withdrawal out of that plan that is taxed as income. It can roll into your spouse's RIF tax-free, or if your spouse has an annuity, it can a life insurance annuity that is paid to you by a life insurance, that could roll over to your, it could also over to your spouse's annuity as well. If you have a dependent child or grandchild with physical or mental disability, the answer is yes in all three cases. If you have a financially dependent child or grandchild under 18, well, the RSP and the RIF doesn't apply for them. But in the case of an annuity, yes, it can roll to that minor child. You can set up an annuity for them, or the estate will set up an annuity for them, and it can roll over to the child if they're under 18, tax-free. Now, one of the we've had already some questions coming from you guys, but so one of this actually the question pertains to this slide. What happens to the PC upon death? Let's assume you're the sole shareholder of that PC. Neither your spouse nor any of your adult children are optometrists, and therefore cannot be shareholders of a PC. So the estate has 14 days to notify the college of the death of the PC owner. Assuming, again, as we mentioned, a sole PC shareholder, the college will advise that the PC no longer meets the condition for having a certificate of authorization. And the PC has 60 days to become compliant, or the certificate of authorization is revoked by the college. Now, once a certificate of authorization is revoked, the corporation is still in place. It is no longer a professional corporation. It cannot practice optometry, but it is a corporation, and all the estate planning strategies that we mentioned earlier still applies, because it is now a non-professional corporation. It becomes like a regular corporation that anyone can put in place at any time. So the shares of the corporation, even after it ceases to be a PC, may be eligible to the tax-free spousal rollover. So your spouse, in this case, let's assume your PC is no longer a PC because the certificate was pulled out. It's now a non-professional corporation. Everything that's in that corporation is rolled over to your spouse on a tax-free basis. In the absence of a spousal rollover, then there is a deemed disposition of the personal corporation. And what happened then, and there are ways to mitigate this, but automatically if you haven't set up an estate planning correctly, the Ontario's probate tax of 1.5% will be charged based on the value of the shares of the PC. Not, it's basically, they'll value the shares of the PC, and then you'll have a probate tax of 1.5% in the absence of a spousal rollover. The capital gains taxes are also subject to the value of the shares, subject to the exemption of the deceased. So in other words, if there is a fairly significant capital gains tax that applies because you're deceased, there is no spousal rollover, the estate can claim your capital gains tax exemption of $813,000, and if your capital gains tax was equal to that or less, there is no capital gains tax that applies. If it's more, then the difference will apply. But now the problem is that if there is subsequent sale of the underlying assets within the PC, that there might be a double taxation. So let's assume that you've used up all your capital gains tax exemption while you were alive. You pass away, there is no spousal exemption. There is a tax that applies then based on your tax rate in the last year where you were alive to the value of the PC shares, and then the estate turns around and starts selling the underlying assets. They might get taxed again. So there is a double taxation that might occur at that time. Now the good news is there are tax planning strategies, and I'm not going to go through them tonight because they're a little bit they're quite extensive. Where you could mitigate both the probate tax and the double taxation risk that applies to your corporation upon death. For example, on the probate tax, you can set up two wills, one that applies to your asset outside the PC, one that applies to your PC, and the shares of the PC don't go through probate. So there are a number of things that could be done that could mitigate those things. But this is something to be very much aware of in case of a disease. Another tax and estate planning that could be done is by an estate freeze. And that could be especially interesting if your PC ceases to be a professional corporation and becomes a non-professional corporation. So, because as we mentioned earlier, in order for you to be a shareholder of a PC and for any family members to be a shareholder of a PC, they have to be optometrists. However, if you come close to retirement and you decide at retirement you want to sell the practice or the practices that your PC holds, you get money. You get, taxes, capital gains tax, depending on how well, your practices have done. You can initiate what we call an estate freeze. If for a reason or another, you don't expect to need all the money that's in your PC for your retirement. So the estate freeze effectively does is that it freezes the value of the assets that would be passed on, or the value of the asset on which they will base the level at which these assets are passed to your children when you pass away. It's done through, and again, we're not going to go through the strategies in more details, but it goes through the issuance of preferred shares that still gives you control over these assets, but not ownership, because now your children are the beneficiaries of these assets. But you have control over these assets because you have the voting rights on these assets, and you draw a fixed income on these assets for as long as you live. Once you pass away, these assets are then transferred to your children at the value at which they were frozen. And even though they may have doubled or tripled in value, they're passed on to your children at the value at which they're frozen, and then they become the cost base at which your children have effectively acquired these assets. So the estate freeze, when you have a personal corporation, and you need to have a corporation in order to make it work, the estate freeze is a very attractive strategy if there is a lot of money in the corporation. Your children cannot be shareholders of a personal corporation, but since you sold your optometry, it's no longer a professional corporation. Then your children can become shareholder because it's no longer a professional corporation. Then you can enact an estate freeze. That may be very, very effective way of estate planning. Another way, one more strategy as well is what we call the buy-sell agreements, and that could be a very efficient, very effective, and in fact, it's something that we would recommend if you have several shareholders that are not related in a professional corporation. For example, yourself and two people you know well, all three of you are optometrists. You create a personal corporation. Each of you owns a third of the shares, and you want to acquire the practice of another optometrist, and the three of you come together, create that company because you can't afford it to do it on your own. Then the issue arises here that what happens if you pass away? Because your estate, is going to inherit, your shares, but your estate is not optometrist, so they cannot be shareholders. You have two other partners who are shareholders who are now running the practice. So you have them. There are a number of legal and also a financial situation that arises at that time. So what happens in these types of situations, and happens in a number of occasions, we structure this for a number of clients where a corporation is shared by several shareholders. It's an excellent estate planning whereby, in effect, the practice buys a life insurance on each of, in my example, the three optometrists who each own a third of the shares, and it pays the premium on the insurance policy of each of the three. That's a life insurance. It's paid with pre-tax dollars, so it's tax effective as well in the way it is paid at that time. And if there is and the value of the shares are determined by the three who decide that, let's say, the value of my shares are worth $500,000. So each of the three, the value of their shares is effectively valued at $300,000. What happened, and we can go to the next slide and see, effectively, if you pass away, then the insurance company that has, on which, again, the PC that hold the optometry has bought three life insurances on the three shareholders. So if you pass away, the insurance company pays the practice the life insurance when you die. And then there is an agreement that has been put in place whereby the PC that's now owned by the other two shareholders immediately pays that amount to your estate, and your estate immediately redeems your shares back to the practice. So, and to the extent that the value of your share increase over time because the practice becomes more and more successful, you can then up your life insurance amount. Each of the three shareholders will, so the payment would correspond to the value of your shares at the time of your death. So this is a buy-sell agreement that is entered into that involves yourselves, your estate, and the practice. And that is something we would very much, urge you to look at if you are several unrelated optometrists coming together in order to create, in order to be equal shareholder or shareholders in a professional corporation. So now what we'll do is that we're gonna take questions. We just at an hour, and I think we've had a few that have been submitted already. So we can start reading the questions and the answers. One question is, can we have a holding company? And the answer is no. So if several of you own a professional corporation, each of you will own personally a certain percentage of that corporation. You cannot create a personal corporation for yourself that owns that percentage of that personal corporation. So the answer is no, you can't have a holding company. Can you pay a salary to your spouse and kids? And the answer is yes, but the expense must be reasonable. And that is one of the big advantages of a personal corporation, in that you need to be an optometrist in order to be a shareholder. And your spouse and adult children would need to be also optometrists in order to be shareholders. But they don't need to be optometrists in order to be employees. So in other words, when you let's say you have a professional corporation, and your spouse doesn't work or works part-time, and you earn already the top income bracket of, let's say, $220,000 or more, every dollar that you will draw will be effectively out of that PC will be effectively subject to the 50% income tax that is now applicable to the high income. But if you have a spouse that doesn't work, that additional $50,000, to the extent that it's a reasonable income that you can explain, would be earned then by your spouse, who is not an optometrist but is an employee of your PC. And of course, that spouse will be subject to a much lower income tax, and that would be one way of income splitting. One thing that we see also are people, for example, who have a child in college, comes back for the summer, and let's say they need the cost of sending them to college for lodging and everything else is about $10,000 a year. If the optometrist were to draw an additional $10,000 a year out of the PC for him or her personally, they'll be charged 50% income tax to the extent that they are earning $220,000 or more. But one thing you could do is presumably employ your child during the summer for doing all kinds of things for your practice. And let's say if you pay them a salary of $10,000, well, anything less than $11,000 is not typically income taxable as income. And for that reason, it could be a very effective tool of income splitting. Another question is, are you legally allowed to convert a PC to a non-PC? And the answer is yes. And the answer is yes. As we mentioned earlier, if your certificate of authorization is not renewed by the college, or if you lose it for a reason or another, or if you retire, you can keep your PC as a non-PC. And one question that came up is, if running an active optometry clinic, it must be a PC during the time it is active. So in other words, if you run a PC, the optometry has to be an active optometry practice within the PC. Once you sold it or once you closed it down, you can't maintain a PC anymore. Okay. So, any other questions?
Yes. Sure. Thank you, Francois. Jim Kraft here. One of the questions that just came in was, how does one establish a reasonable salary? The word reasonable comes out of the Income Tax Act, and as a practitioner, we would probably look to the cost of hiring a stranger to do the same work. So if you're hiring your spouse, how much would you pay your sister-in-law to do the same work in the practice, and that becomes the reasonable salary. Sometimes you can expand that by a few percentage points, but you have to start with that starting point. Another individual asked, young optometrist, not yet incorporated, what are the income splitting opportunities? And again, I would probably turn to looking at a way of hiring the spouse in the practice to do some reasonable work that someone else would have been doing, and that would lower the optometrist's income and give the spouse some income.
What is the difference between paying yourself a dividend versus bonus?
Paying yourself a dividend versus bonus.
Well, if you pay yourself a bonus.
Sorry, so the question is, what's the difference between paying yourself a dividend versus paying yourself a bonus?
Right. So just a bonus essentially is similar to a salary in the sense that you're paying yourself a bonus that will be taxed as a form of T4, and hence will be taxed at your marginal top rate. A dividend, if it's depends on the type of dividend you're paying yourself within a corporation. If it's an eligible dividend, i.e., it relates to dividends that you resulting from shares that you own within your PC, that would come out. You can pay yourself an eligible dividend, and that would be taxed at, I think it's 33.8%. If you're to the extent that the income within the PC is as a result of active business income below that 500,000 threshold, and you want to pay yourself a dividend out of that income, then that would be subject to what is an ineligible dividend. The reason for that, and that's taxed at the 40.1% rate, and the reason for that is because it's being taxed at a much lower rate within a PC. So really, as we pointed out earlier, the benefit of a PC is to the extent that you are able to accumulate savings within a professional corporation. Then you get the tax benefits associated with it.
We're looking at the questions.
Okay, so here's the.
Okay, so one question is, when shares in a PC are sold at retirement, is there an amount up to which lifetime capital gains exemption would apply? Can the control of the PC be transferred to a new owner, but the corporation assets be retained? So the capital gains exemptions, I'm going to pass it on to Jim, but I'm going to pass it on to Jim Kraft.
All right. The capital gains exemption is an individual would sell his shares of his optometry practice. He would realize a capital gain on selling those shares. And the capital gains exemption can be claimed to lower his capital gain exposure. So the capital gain exemption today is $813,000. It's to be indexed over time. But one has to be careful because there's certain criteria that must be met to qualify for the capital gains exemption. It's a little bit beyond the material tonight in terms of the three rules, but you would certainly consult with your tax and accounting professionals to either make sure that you qualify when you're ready to sell, or the accountants and lawyers that you work with could do something called crystallize, where they capture the capital gains exemption and make sure that it's in the cost base of your shares. There's another question: if an individual sells his corporation at retirement, can he keep the investment assets that were built up? That gets very tricky. We would probably have to look at the amount of assets that are there. There's a possibility of that, but there's other tax planning strategies that could accomplish to the same end that might be easier for us to play with that. When you get down to the specifics like this, it's easier to really develop the plan in conjunction with your accountants and lawyers to understand what would be involved in accomplishing it. But the key really is to start planning well in advance, is to try to stay on top of this all the way through your working career so that you're not scrambling in the last couple months at retirement getting organized for this.
Yeah.
The questions are a little small.
Yeah.
Are they in order?
Not
My wife has an
necessarily.
optician. Can she have regular cooperation? Okay, so one question is, if my wife is an optician, can she have a regular corporation and I be the shareholder as an optometrist?
My understanding is that your wife's corporation can be owned by any types of shareholders. It's not a professional corporation. Therefore, anyone in the family can be a shareholder. You may actually want to think about a family trust being a shareholder. This way you can add yourself, the children, and other relatives in as beneficiaries of the trust and indirect shareholders in that fashion.
Okay. The assumption is that he is still practicing optometry. Statement made earlier that once OPC is sold, OPC has to be closed. Okay, so one question is, the assumption is that he's still practicing optometry. The assumption, the statement made earlier that once the OPC is sold, then the OPC has to be closed. The OPC doesn't need to be closed once the optometry practice is sold. It's if you have 3 practices and you sell one, obviously you're still a practicing optometrist. But if you sell all your practices, then your professional corporation is no longer an active optometry professional corporation. The certificate of authorization by the college would then not apply or be revoked. And at that time, you become a non-professional corporation. Your corporation doesn't have to be closed. It just lose its professional status. Like as we say, it loses the P but not the C. So it's no longer a professional corporation. It becomes a regular personal corporation.
We have a very interesting question. An individual has been very conscientious about income splitting so that his personal tax return shows very low income. But now when he's applying for a mortgage, the bank is looking at his personal tax return saying you don't have enough income to qualify for the mortgage. That is going to be a sticky problem. We have worked with some banks where we've borrowed money, but we've had to use the corporate assets for security. That gets a bit complicated. I think someone like that, we really want to take them into a more sophisticated lender and then get them to understand what you're doing, how you're doing it, and that the assets are there to secure that type of a loan. John, the questions come in about the specific rules for income splitting. Do you have a few income splitting strategies that are out there?
Well, in terms of income splitting within a corporation, I think we mentioned that earlier. It's really a question of paying a reasonable salary to a spouse or a child of age of majority to work within the practice, and doesn't have to be an optometrist. As far as income splitting as part of a retirement vehicle, that would essentially would require a certain amount of thought, and obviously there are strategies around that, but it would have to take into consideration taxes and other aspects that we'd need to look at before we can make a judgment on that.
Okay. Well, there was a follow-up question to yours. Is there advantages to paying yourself a salary versus a dividend, or tax brackets to consider?
It all again, if to the extent that the income is being generated within a corporation is solely active business income, and let's say to the extent that the active business income is $200,000 a year, and you need $200,000 a year to live on, there is really no value in a PC at that point, because essentially you will be fully taxed on the way when you take your money out. But to the extent there's extra savings in the corporation, and you are able to invest the savings in dividend-paying stocks, as an example, then you can pay yourself a dividend in the form of an eligible dividend, and that will be taxed at 33.8%, as opposed to being taxed at 49%. Furthermore, you can also, as Fraser mentioned, set up a pension plan strategy that would allow you to get money out in the future on a very tax efficient basis.
One question that came up is, can corporation invest in different investments like TFSA? I was told business accounts cannot have TFSAs, so that if that was the case, how else can we invest GIC stocks? Yes, TFSA is a registered instrument, so the professional corporation cannot invest in a TFSA because the TFSA was designed for individuals. However, when it comes to investing, the type of assets in which the professional corporation can invest is fairly open, in that there isn't really from either the college or from anyone that would actually force you or determine what type of investment you can invest in. So yes, you can invest in GIC, you can invest in stocks, you can invest in mutual funds, you can invest in exchange traded funds. You can purchase insurance, which could be a very tax efficient way of investing. What the college specifically, and this is something that we would recommend also you speak to your tax advisors with, but what the college states typically that there has to be some reasonableness in what you invest in. So as we said, these type of product you can invest. We've seen professional corporation invest in real estate. If you have your practice in a building and you buy the whole building, and you collect rent, and that is something that has been done before. So as we said, it's a fairly liberal kind of rules as to where you can invest in, and your tax advisor would be best to confirm that to you. But that is our understanding from the college.
Next question we have is, can an optometrist open up a non-professional corporation for the sale of eyeglasses and still keep his professional services as a sole proprietor? There's no barriers to doing that. It is going to be a bit complicated for bookkeeping, but you could certainly open up a corporation to do all non-professional services, have a family or a family trust own it, and keep your professional service in a sole proprietorship. You can split these things up. It's just a matter of keeping track of all the paperwork.
All right, we just have time for just one more question, but I do want to give thanks to BMO Nesbitt for taking the time to come out and help us with all their wealth of information. So thank you, Francois, John, Fraser, and Jim for answering all these questions. Just a quick note to all the listeners that are still out there, the PowerPoint will be up on the practice management section of the OAO website tomorrow, and the final recording will be posted in the next few weeks, so please look out for email postings regards to that. I do want to thank you once again for obviously being members of the OAO. I do believe in giving back to our own profession and helping us succeed. So thank you once again for attending.
And Doctor, just one more point as well. The question that we haven't had time to answer tonight, we will be answering them as well in writing and submitting them. And there is one point with respect to the capital gain exemption that would avoid a confusion. The capital gain exemption applies to the shares, to the value of the shares of your PC, not to the value of the underlying assets of your PCs. So if you do sell, if your personal corporation sells underlying assets, whatever capital gains you've earned is not subject to the capital gains exemption. The capital gain exemption would only apply if you sell your personal corporation as is and you get a value of your share at a certain level. Do you have time for questions? Okay.
Thank you, everyone. We're going to wrap up for the night, and thank you for your participation. And just watch for those postings in the next week or two. Thanks, everyone. Have a great evening.
Thank you.
Thank you.